I'm going to explain 4 ways to gift money to family members without creating tax issues or family tension. I'm Elliot Apple, founder and financial planner of Kindness Financial Planning, and today we're going to talk about the best ways to gift to family members. This is one of the most common questions I receive from folks, and it's one that's often a point of confusion, so let's make sure you do it properly. Let's start with why you might want to gift money to your kids, because oftentimes I find people have more than enough in retirement, but they're not quite sure what to do with it or they don't feel quite secure. So the first thing to do is to make sure you feel secure in giving these gifts. But once you do, here are some good reasons that you might want to. In my experience, buying a house is a really difficult thing to do, and parents are often trying to give their kids a leg up. So by gifting them money on an annual basis, it allows them to build up enough for a down payment. Or maybe your kids are trying to start a 529 plan for their kids. And in that case, a gift could go a long ways to super funding that 529 plan to give it a boost into the future. Or maybe you just want to see them and experience how they handle and use money today to decide how you want to structure an inheritance, whether that's going to come with more rules or less rules with an outright gift at the end of life. Whatever your reason, gifting money can be a very meaningful and impactful thing, but we want to make sure that you do it properly and you don't run afoul of the rules, and you're doing it in a way that helps both your kids and potentially you. The first thing that you need to know about giving money to family members, or really anybody, is that there is an annual gift tax exclusion amount that is $19,000 in the year 2025 or the year 2026. It is staying unchanged for 2026. And that's really important to keep in mind, because if you give more than $19,000 per year, you need to file a gift tax return. Now, don't think of this as money that you need to pay to the IRS or do anything else. It's really meant to be an administrative or sort of check the box to tell them that you gave more than the annual gift tax exclusion amount. And in 2026, everybody has a federal lifetime exemption amount of $15 million. So for most people watching this video, probably not going to be an issue if you give above that $19,000. All it means is that you have to file a gift tax return, Form 709, and tell them that you gave more, and that will count against that federal lifetime exemption amount. Now, it is important to note that that federal lifetime exemption amount has changed over time and will likely change in the future. It could be lower, in which case that might be an issue down the road. But for a lot of people, it's going to be a non-issue, but it is worth mentioning. The other thing to know is that if you are married, you each can give $19,000 per person. So if you are married, you can give up to $38,000 per year to any single individual person, assuming that's coming from a joint account or if you give separately out of separate accounts. Now that you know the rules, let's talk about 4 different strategies you could give to give that $19,000 per year, or if you decide to give more, how to give that. The first option that a lot of people are familiar with is just a straight cash gift. That is the simplest way. You can make it an even $19,000 if that works, or you can give less. It's really up to you. But that is the simplest way. You can write a check, you can make an ACH payment, you can give them cash, I suppose, if you really wanted to. And that's the one that people are most familiar with. It's helpful for the person receiving that because there's no sort of tax consequences. They just receive that $19,000 and they're good to go. As we talked about earlier, that can be used to build up money for a down payment. So if they needed $100,000 and you're giving $19,000 per year, that might change as the annual gift tax exclusion goes up in the future. They'd have that money after a few years, and it would prevent you from needing to file a gift tax return as opposed to giving $100,000 in a single year. They could also use it to fund a Roth IRA or do anything else with that money. They could go out and buy a car. This is where you get to really put it to a test and see how are they actually going to use those funds. Have you given cash before to family members? If so, drop in the comments down below what that experience was like. What did you notice? What did they spend the money on? How was it used? Option number 2 is to give stock. And this is a less common strategy, but one that can be helpful if the person that you're giving the stock to is in a lower tax bracket. So if this is coming from a brokerage account, for example, and let's say you're in the 15% or the 20% long-term capital gains bracket, but you're giving it to someone who has lower income, potentially they might be in the 0% long-term capital gains bracket. And this is important to recognize because if you don't necessarily want the tax consequences yourself of selling this stock and then giving the proceeds to them, you could decide, I'm going to give this ABC stock that I bought many years ago. And the problem with this is your basis is going to carry over. Now that's a problem for them, not necessarily for you. So it's beneficial if you don't want to sell that stock, you don't have to recognize the capital gains. You could give this stock. There aren't any tax consequences at that moment other than potentially needing to file a gift tax return if it's above $19,000, and your cost basis will carry over. So let's say a very simple example that you paid $1,000 for the stock. It's now worth $10,000. You could give it to them. All it means is that cost basis of $1,000 is going to carry over. So if they were to sell that immediately when it's worth $10,000, they will owe $9,000 worth of capital gains. Now, again, the benefit is you're not recognizing the capital gains they are, and if they're in a lower long-term capital gains bracket, that can be helpful for both of you. Strategy number 3 is to fund a 529 plan, and you could potentially super fund a 529 plan. 529 plans have special rules in that you can super fund them in a single year, file a gift tax return, and then split that gift over 5 years. So you could take that annual gift tax exclusion amount of $19,000 and give up to $95,000 per person, and then split that gift over those years, filing that gift tax return. So you can make a lump sum deposit of that $95,000 into the 529 plan, make no additional gifts into those future years until those 5 years catch up or so. There are special rules with this. Make sure you understand them. But this is a common strategy, particularly for grandparents, to give to grandchildren when they're really young. That $95,000 can go a long way. Maybe they make that lump sum and they don't make any other contributions going forward, and they'll have potentially a fully funded 529 plan depending on the schooling choice that they make in the future. Now, if you're a married couple, you could give that $95,000 times 2, so $190,000 total. Now, if you don't have $190,000 or $95,000 on hand, that's okay. You can also just make gifts directly to the 529 plan. That can be really helpful, even if it's $1,000 or $500, whatever amount you have to give. It can really help that next generation, particularly if you start early. That compounding, it gives it time to actually work in your child or grandchild's favor. Strategy number 4 is to pay medical or educational expenses directly. And directly is the key word here. So as I talked about earlier, you can give $19,000 per person in 2026. But if you go over that, you have to file a gift tax return. Now, one of the few exceptions to this is paying medical or educational expenses directly. So if you know someone with a really large hospital bill, you could pay that hospital directly. So if the bill, let's say it was $50,000, just a random number out there, you could write a check to the hospital for $50,000, and that wouldn't go against that $19,000 gift tax exclusion amount. You wouldn't need to file a gift tax return for that. So it can be really beneficial to pay those directly. Same for tuition. If you have a grandchild in college and tuition is $40,000 a year, you could pay that $40,000 directly. And again, you're not going above that $19,000 exclusion because you are paying it directly. And again, directly is the key word here. If you give $40,000 to the beneficiary and then they turn around to pay the college, that is an issue. You're going to have that $19,000 and then need to file a gift tax return for the amount above it. So as long as you're paying those medical or qualified educational expenses directly, that is okay. Now, the last strategy, which isn't necessarily a gift if done properly, but it can feel like a gift, and that is creating a loan using applicable federal rates or AFR rates. And why this can feel like a gift is because AFR rates tend to be lower than what you'd get at a bank or a credit card, or just trying to find a loan provider out there willing to lend at a very low rate. So if you have a family member, you don't necessarily want to make an outright gift, but you want to be generous and offer them a low interest rate loan, you could do this using the AFR rates. This could be for a house down payment, it could be for a house, it could be for education, a car, or whatever it is that you want to fund, whatever they need for spending there. This is a way to do it. And rates can be extremely low. Go on and look at current AFR rates that come out monthly. You can see for a short, medium, or long-term loan, look up what those terms mean in terms of the timeline there. As long as you're matching the timeline of the loan with those AFR rates and you're lending at the AFR rate or higher, you're not making a gift. Now, if you structure a loan, let's say you wanted to offer 0% to a family member or a friend, that is a potential issue there where you potentially are making a gift, and that needs to be filed potentially if the loan is large enough with a gift tax return. So it's really important to pay attention and structure the loan in a way that works for the two of you. And I'm not saying one way is better than the other, but this is one way to do it, is using those AFR rates to offer a very low interest rate loan that they can pay back over time. Now, let's spend a moment talking about the emotional side of gifting. First, it's really important to be clear on whether this gift is actually a gift or whether it's a loan. You don't want to muddle those waters because it can become a huge issue later on. Second, are you okay never seeing this money again? And this goes back to the first question of, is this an outright gift? And make it clear with those intentions of, this is a gift, I don't expect it back, because we don't want awkward family dynamics later or some resentment of not getting that money back. And lastly, is it fair to other family members? If you gift to one child and not the other, is that a discussion in the family? Does it need to be a discussion? You don't necessarily need to explain yourself to family members, but I find if you make outright gifts to people and it's uneven, oftentimes that can breed resentment and cause issues later on in life. Generosity can really strengthen relationships. I've seen some very meaningful and impactful gifts made throughout life, and it really gives those a leg up who are receiving them. And so think carefully and intentionally about how you're making these gifts. Make sure you make it easy from a tax perspective for you and the beneficiary of that, and create a plan going forward and change it as needed. Oftentimes people start giving smaller amounts, and as they get more comfortable in retirement, they feel like they have their financial independence, healthcare is taken care of, they can start making larger gifts as they see that their money is actually growing throughout retirement. Because you want to make sure you take care of yourself and your financial independence is secure, and that's when you can start helping that next generation, family, or friends. Thanks for watching.